Hi everyone, welcome to the 105th episode of the Timing Research Show for September 26, 2016. Welcome to the 105th episode of... my name is David Kosmeter. I'm the creator of Timing Research, and today we will be discussing the 157th weekly report. So if you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download this or any past report there. I have Matt Buckley back to host today, so I'm going to go ahead and turn it over to him. Hey, Matt, I can't hear you. I still... You guys can't hear him, right?
No, I cannot.
No.
Can you hear me?
Yep.
Do I need to take over for Whiz?
Yeah, let's let him work on that. And yeah, I still can't hear you, Matt. Okay. Yeah, let's see. Christian, if you want to go ahead and tell everyone a little bit about yourself and your site and what you do.
Yeah, sure. Thanks so much, David. So my name is Christian Fromhertz. I'm the CEO and founder of Tribeca Trade Group, and I run an options trading room. And my background is I was an institutional trader for Merrill Lynch for a long time, also at Bank of America, Merrill Lynch, once the merger went through. So my background is I was a senior ETF trader for the bank. And I also did a lot of trading on their Delta One desks, a lot of program trading, a lot of index trading. Also traded single names for them. So Tribeca Trade Group is a trading room that's been open for about 6 months now, and just bringing a collaborative type trading room to retail investors. So taking a lot of things that I used to do as an institutional trader and bringing them over to the retail side and trying to help out retail traders navigate this tricky market right now. Thanks, David.
Okay, sounds good. Eric, let's go to you.
Hello, my name is Eric Wilkinson. I'm with Pro Trader Strategies, and what I do is I'm doing educational videos on teaching the retail trader as well how to trade options according to some of the rules that I've generated throughout my 20+ years as a trader. I actually started out trading in college, then moved to Chicago to start working at the Board of Trade, and was a floor trader for over 20 years. So I'm trying to take some of that knowledge, some of those floor trader hacks, if you will, and bring them to the retail trader. I feel like the more people out there that understand this, the better the markets are. So, and the better the markets are, the more that we all will be able to be profitable in these types of derivatives, if you will.
Can you guys hear me? I'm back up.
Yep.
Yeah, I can hear you.
Yep. Okay, sorry
so
about that.
Yep, no worries. So I do weekly webinars on Friday, and then I do a market commentary every single day where I talk about the trades I'm putting on, where and when I find them appropriate, how I'm managing some of those, because as we all know, we do have trades that go against us, and I talk about how you can manage those into profitability. So we have a lot of things going on over there that you can check out at Pro Trader Strategies.
All right, sounds good. Matt, I'm not sure if you heard that, but we got through Christian and Eric's introduction, so I'll
Great.
Back
Yeah, sorry about that, folks. Of course, everything works. Your microphone works perfectly during microphone check 5 minutes before, and then 5 minutes after it doesn't work. So my apologies. So Roy, why don't you tell us who you are, where you come from, and what do you do at Steady Trader, and a little bit about your background, a little bit of an executive summary there.
Sure, Matt. Glad you're back up. We have Steady Trader as our website. We have a pretty simple philosophy, which is short, fast trades, getting in and out between 1 to 4 days, more or less. We feel this is the most appropriate strategy for the market, the way it's been really for almost 2 years now, pretty much, range bound, flat. So it's very simple. We do daily reports. We do daily market commentary on the overall health of the market as well. I've been trading since basically the online trading boom started way back in the late 80s. And I was consulting for 10 years for various trading education companies, went out on my own with Steady Trader about 2 years ago. And that's it.
Awesome. It'll be interesting to see what your short-term take is on the market, especially going into the election coming up here. And finally, rounding out our panel today is Jim Kenney from the optionsprofessor.com. Jim, good to work with you again. Give the folks an executive summary of you and what you all do at Option Professor.
Well, what I do at Option Professor is I've provided the content for Option Professor for a very long time. And basically, it's 7 DVDs that we've put together that helps the retail person or persons who want to learn about options and all the different strategies. Not recommendations necessarily, but just understanding the different tactics and how you can work with the different tactics. So when you go into a situation, your menu of choices is rather significantly wide, and then you could maybe select a choice where you think the risk reward or the appropriateness is right in line. So basically, we've done this for a very long time, and people have benefited from the DVDs as far as increasing their knowledge and confidence on what they're out there trying to do.
That's great, and you really are a man after my own heart, so to speak, Jim. You use the right term. You use the right term that we use here, Top Gun Options, which is it's an options tactic. It's not a strategy. So very well said, and you can tell the guy's a pro. Well, as David said at the beginning, my name is Matthew Buckley. My call sign is Whiz, and I don't have enough time in the day to tell you why I earned that call sign, or actually, it's a 10-drink minimum. And I don't see anybody drinking in here yet. I think Eric might be. I got my eye on Eric. But I flew F-18 Hornets for the United States Navy for about 15 years. Graduated from the Navy Fighter Weapons School, which many of you know as Top Gun. And I also flew 44 combat sorties over Iraq. All during that time, however, I was teaching myself how to trade equity options and applying what I was learning flying fighter aircraft, having a strategy, implementing tactics, contingency planning, knowing when to get out of a bad situation before it got worse, or knowing where to, when to declare victory and actually get out before it got worse. Eventually, based on my trading success and prowess, I popped up on the radar of one of the largest, or actually the largest volatility arbitrage firm now in the world that trades equity options. It's called Peak 6 Investments in Chicago. So ran up to the board of trade and the SIBO for about 3.5 years. Did that for a while, became the CEO and founder of the Options News Network, given CNBC a run for its money since they throw John and Pete on there as kind of afterthoughts. So I had an absolute blast and decided to head down here to South Florida and start Top Gun Options about 6 years ago. And I'm also the chief development officer of a hedge fund located up there in the Great White North, which is a great place to visit. And no offense to anybody who lives in Chicago, I hated it, except for the 2 days a year that it was nice out. So let's jump into the report here. I probably offended like 15 people on this webinar. Let's go through, including some of my peers. Let's go ahead and go through David's report for the week, and let's just keep that batting order for the rest of our hour together. Christian, Eric, Roy, and Jim, and then I get to bat clean up at the end and tell everybody they're wrong, right, or if there's a mixture. So the first question to you, Christian, out of the gate is, what direction do you think the S&P 500 index is going to move from this morning's open to Friday's close?
Gotcha. Well, I'm extremely offended by the Chicago comments. No, I'm just kidding. I'm from New York, so I'm good. I'm with you.
Okay.
You may have other reasons for not the New York, but we'll stay away from that from now.
I'm from Jersey, exit 44, so we'll talk after.
Yeah. So I think for this week, lower. Do we want the reasons yet, or is that question number 2?
That's question number 2. Just give us a high or low type of thing, and you can give us 50 reasons in about 3 minutes.
All right, cool. So I'll say lower for now. I'll come back to you.
Okay. And Eric, over to you.
The last couple of times I've been on here, I've said lower, and it had a tendency to go higher. My portfolio right now is delta long. So, and that's only because I've taken off some positions there. I'm starting to add in some more negative deltas, but at the end of the day, I'm going to have to lean towards higher, because in the bizarro world that we're in, these bad economic data points that we've been getting out, and we're going to be getting some later on in the week that I think are going to show more of a recessionary kind of feel, and I think that that's really going to push this market higher, despite the bizarro thinking that there is behind that. So I'm going to push a little bit higher.
All right. Love disagreement. It works. Roy, where are you going?
It's going down. It's going down. It's going down.
It's like Titanic.
I'll tell you why later when we have that round.
All right, we have 2-1. And Jim, what are you thinking?
Well, I think it should be going down, but that's not going to be what I'm saying. I'm thinking it should be way down, but the thing is it may go up this week, and a couple of reasons are technical. One is we went down to 2140 on the December future on the S&P, and I'm looking at the gap somewhere between 2160 and 2170 on the chart. So that's tending me to think that they could gravitate back there. And then the VIX has a gap between 12 and 14. And it had a big 15% jump today. So if the VIX were to go back down into the 12 to 14, then going up into that 2160, 2170 might happen. So I'll just say that it's possible that it would go up towards a little bit the 2160 area.
Okay, like I said, the best part about going last and being the moderator for today is everybody's a little bit wrong and everybody's a little bit right. The answer is, of course, up. And we'll get to why up here in a little bit. I'd like to point out, folks, that was it 2 weeks ago when oh man, I was hosting, and Friday the market had imploded on one of the Fed lieutenants' hawkish comments, and then that whole week we had the heart rate monitor. 5 of the guests on my esteemed panel said we were going down, and I of course said we were going up. So there's my track record right there. I'll leave it at that. All right, now we'll move on to question number 2. Go ahead and rate what your answer is. What's your delta based on what you said? Christian, you let us off.
Sure. So similar to when I've been on before, it's probably right around a 65 delta. It's, this market has been extremely tricky to pick direction. It's almost like you have to set up for one day at a time right now, because we're 1 minute we're going higher, and the next minute, oh my God, we're going lower. So, I think you have to kind of, I don't think in this environment you could be too far on both sides of the spectrum. I think you just kind of have to set up with your technicals and say, what are you going to do if we get to here? And what are you going to do if we get to here? So I stick with, I think I've had about 65%, I'd say, just about every week the last 3 or 4 times that I've come on, because I think there's a chance that we do move higher, in the longer term, but there could be some volatility, especially this week with the events that are going on. Now, do we want more of an explanation now, or are we coming back for more reasons?
Hey, Matt, you're muted again.
Yeah, the third question will be the answer why for all of our guests that you're predicting what your prediction. All right.
Okay, so I'll hold back from now. Thanks.
You bet, Eric. What's your delta? Higher on your higher or lower?
It is pretty close to neutral. I'm going to say about a 56 delta for higher.
Okay, Mrs. Clinton, thanks for that.
I'm telling you, I'm a consummate bear and a contrarian. So we're at these near highs. I can't help but add short deltas to my position. So in that, it doesn't make sense to me if we're going to have bad economic data that the market goes up. I mean, just as long as you've been trading as well, it used to be bad data meant bad for the equities, and it doesn't mean that anymore. So I think we're going to see bad economic data. So I think that the market's going to push higher. But
I couldn't agree more. I mean, at TGO, we call it bizarro market, where good news is good news, bad news is good news, and awful news is great news. You're right. It's so 2008 of us to consider a horrible durable goods report something to cause the market to go down, especially under Bernanke. It was so great. They're like, anytime we had bad news, everybody giggled like, well, there's no way in hell he can pull that $85 billion a month out from underneath us. So, suck on that. So you're right. And weaning off of that Fed hopium is what I think might end up killing us there. So, Roy, what say you, my friend? What's your delta on your prediction for the week?
Oh, Roy, I think your mic was picking up sound when someone else was talking, so I had to...
Okay, there we go. Hi. My delta is pretty low as well. Like Christian said, we do set up every day and we do reevaluate on a daily basis, and pushing out to Friday is a little beyond my predictive zone, but I'll say 60%. And I'll talk about the rationale in the next round, yeah.
Yeah, all right, that's pretty good. 0.6 delta's looking pretty good. And then Jim, over to you.
Well, from what I'm seeing right now, it could be 60 delta as far as the guess is concerned. But if we take out 2120 on the S&P, that probability goes down to 0.
Interesting. Wow.
Okay. In other words, it could pop up here, but if we started taking out 2120, then that'd be the time to get the umbrellas out.
You sound like the guy on The Price is Right who bets $1. He's like the last guy that gets to go. And puts
actually, what I'd like to do is bet both sides because the VIX is fairly low, and with the debate and what's coming up later in the week with GDP and a lot of other stuff, I'd rather just take both sides and then go to the beach. And let you guys figure out if it's going to be up or down.
There you go. Well, hey, you're right. As an options trader, straddle, strangle, whatever you want to do, man. I don't care which way it's going to go. I want to potentially make money. So, okay, good. Well, I'm the last to go, which obviously means I'm right. There's a 100% probability of the market being higher from today's close by the end of the week. And I'll get into that after you guys all muddle around through yours. Mainly because either as a trader or as a naval aviator, you never squeeze the trigger in combat or just closed your eyes and hoped a bomb hit where it was supposed to and it was bad guys. You got to have a pretty high confidence of what you're doing. So unless you're the Russians, then you just carpet bomb Aleppo and commit war crimes. But that's another discussion. All right, Christian, let's get into the meat of this, man. Start digging because I know you're chomping at the bit. Whiz, I got 99 problems, and let me tell you what they are with the market this week. So why don't you lay on us why you think for the week?
Yeah, sure. Let me just go ahead and I'll share my screen too, just to kind of give a couple levels here. Yeah, so I mean, at Tribeca Trader, what we normally do, and I draw upon my background as an ETF trader and kind of look at that macro trend and look at what we're seeing in terms of big flows. And it's really has been a lot of chop. So both in terms of flow and ETF flow, money is being added to equity ETFs, but it's at a slower pace. We also draw upon option activity for kind of a shorter term trend. And, we're seeing little bits and pieces of different sectors being bought up. It was a little bit of energy prior to this, energy meeting that we're having. A week ago, it was more biotech. But we're just not seeing a lot of teeth in terms of, people really committing a lot of capital. And I kind of draw to it. It seems like everybody's around like a 50, 55, 60 delta. So just not a lot of conviction in this market. And, I look at value areas, I look at volume at price. And, last Thursday, we looked great in terms of technicals, after the Yellen speech. Once Yellen got through that press conference, the market really wanted to rally. It did that, but that was the high point. And, in the S&P, we've not been able to take out the highs here. And, Friday, we didn't have a engulfing. We kind of have an inside day, but it kind of confirms the move that, we're moving back into this lower, into this lower range. So, I'll wait for confirmation. I think, we need to go back above, I would say in in S&P futures, I would say 2159. I really look at the three major indices. I look at S&P, I look at the Qs, NASDAQ, and I look at small caps. Very rarely do I look at the diamonds because I think it's kind of more of a flawed index. It's price weighted. It's only 30 names. But I'm getting a little bit of a clue from the diamonds on the daily chart where, I could put this in my newsletter this weekend that, hey, we almost got into value for the month and a pretty clean rejection of it. And it looks like we're back into this mess. So besides the technicals, besides there's not a lot of conviction just in the market, and as what everybody else, as what you guys are saying on the panel, also we've got events this week. Tonight, I think everybody knows we have the first debate tonight. And I think, from what CNBC and the banter on Twitter is saying that, it could go either way. I don't think in terms of, the U.S. market, there's going to be a winner, regardless of who wins or regardless of who wins the debate tonight. I think these two are going to rip, they're going to rip each other apart. And I don't think that that's good for the economy. I don't think that's good for the market. It's going to create uncertainty. And then finally, sorry to kind of go on for a little while, but then on Thursday, we have Janet Yellen speaking again. And, if the market was expecting an interest rate hike for December, I would say, okay, there's some room that, maybe the market expectations are too high for expectations into an interest rate hike in December, but they're not. Right now, the Fed fund futures are only expecting a 52% chance of a rate hike. So they're too low. So even if she comes out and says, hey, we're not ready, which I don't think she's going to say on Thursday, we're not ready to raise interest rates, the market is already not expecting it. Despite what she said earlier last week, the move went from a 55% to a 52%. So clearly the market is not believing that it's going to take place. And when the expectations are this low, there's not going to be anything positive, I think, that she could really say that's going to bring the market. So I think we're without catalyst for the time being.
Very, very interesting. All right. Well said, Christian. Eric, what's your take on all the events this week and why you think the market's with your perennial bear attitude heading the way it's heading, the way you think it's heading?
Well, I do think it's going to be heading higher, only because I think that despite what the Fed, we have a lot of Fed governors speaking this week, and at the end of the day, I don't think that they're going to raise rates going into a holiday season. Right now, our economy isn't looking that great. Why raise rates going into one of the main driving factors of this part of our economy, so the retail side? So I don't think that they're going to raise rates. They have a history of never raising rates during a holiday season. And on the Fed funds futures, pricing in a percent of a hike coming up, that's true. But if you even look on into 2017, those rates are actually looking like they're going to start lowering rates again. So there's a high probability of that happening if you look at that backwardation, if you will, in the Fed fund pricing. If you look at it for the interest rates, it's showing that the interest rates are going to go back down. So that's pretty along the lines of what I'm thinking. They're not going to raise rates because of bad economic data. We also have a ton of oil coming onto the market. So I think that the market is going to push higher for all the reasons I said in the other three comments that I wasn't supposed to say. And
that's all right. It seems like, so, because I'm like you, believe it or not, I'm a hiding bear because I know for a fact we shouldn't be up here. I was in the Keys last week speaking to Amcor. I'll be in San Diego in a couple weeks giving another keynote to another company. I fly around the country and the globe, and I give keynotes and do consulting with companies. Not a one is doing, hopefully they're not listening, I won't name their names, is doing well. Nobody's hiring. Nobody's firing. Or people are firing. Nobody's acquiring. People are walking around with these big, thick laptops or laptops with, Vista on them. I mean, it's a bad, the economy sucks. And all the people on this webinar today live on Main Street. And we all know it just feels like it sucks. And the data kind of bears out that it's just kind of this, And the only reason we're up here is on easy money from central banks, and 2-3 years of Ben Bernanke getting us all high. So I think this market should be half of what it is, but I completely agree with you. But and I'm sure you say this to your folks, you got to trade the market you have, not the market you want. And obviously, Eric and I kind of agree that the market, not necessarily we want, but is a hell of a lot lower than here. As an options trader, I don't care where the market is. And I know Jim can say the same thing. He's like, up, down, sideways with options, we could potentially make money. So, Eric, I agree with you, man. So it's kind of a hold your nose trade, I guess, is what the point I got from what you were saying.
Definitely.
So, good. Okay. All right. Next, let's move on to Roy. Roy, what's your thought on what's going on this week and why you said what you said earlier? You might be on mute.
Dave keeps putting me on mute. There we go. We run the same indicators every day. We use some Wilder stuff, ADX3 for short-term trends, and we use the RMO oscillator. And what we're seeing is that, as Christian said, we had a period of real chop there from about the 8th to the 20th of September. And we had our little party after the Fed announcement last week, but now we're going back down, and our readings are looking just like they were during that period of, like the first couple, well, not the second and third week of September. So again, that's what our indicators are showing us, is that the short-term trend is going to be down. Now, when it comes to events, yeah, I think the debate is kind of a lose-lose. I don't think anyone's going to be happy with the outcome. I think you talked about hold your nose trade. This zillions of people talking about the hold your nose election. So it's just not a happy time with the politics, and we're seeing that all year because presidential election year is really supposed to lift all the boats, and it just ain't happening. The oil meeting, nothing's going to happen there. I think we all already sort of know that they can't agree on anything, and the Fed's got nothing to say. Yeah, they're not going to raise the rates. There's no way they're going to raise the rates before the election and the holiday season too. So we're just going to go with our indicators, and the indicators are showing that the market's getting back into this this land of sort of unstructured weakness, where it was for the beginning of this month and so much of the summer, really.
True. Okay, Jim.
Yeah, as far as this week is concerned, we've got a lot of stuff hitting the wall. We've got the debate tonight. Then later in the week on Thursday, we've got the GDP. And then Friday, we're going to get a lot of stuff on the consumer, personal income, and consumer spending and stuff like that. So this could be a pretty darn volatile. Tuesday sometimes turns things around, turn around Tuesday, and Thursday sometimes sees things turn around. So I'm expecting that the market, may get pretty wild here. In the last, earlier this month, the VIX went down to about 1112. Last week, it went down to 1112. Guys who trade weeklies and end of months, obviously, could take advantage of strangles on extremely low premiums. And, we got a big jump in the VIX of 46% right after that slow period in the beginning of the month. And some of those weekly and end-of-month options exploded in price with a limited risk on both sides. So that also kind of happened a little bit last week when we went under 12 on the VIX. So it'll be interesting this week to think that nothing will happen. Of course, that's probably what will happen. But there's enough meat on the bone here this week to get people moving around a little bit.
Yeah, I agree. I almost don't even have enough time to go through everything that's going on this week. This is a huge macroeconomic data week. New home sales, even overseas, Mario, Kuroda, over in Japan, Conference Board, consumer confidence numbers. Everybody, already said, from Fisher. I think he's the executive officer or wherever he's from. I get my Fed lieutenants confused. Core durable goods. Yellen speaking twice in front of that one's the House and one's the Senate, Wednesday, Thursday. It's like she's going to be sitting there telegraphing what she's going to be doing with interest rates. So it is an action-packed week all the way to Friday, Chicago PMI, everything. There's everything going on this week. And as everybody hit on, the debate. I'm going to go against the conventional wisdom. to be honest with you. The conventional wisdom, I've done it for most of my career and printed money doing it, because usually the conventional wisdom is full of people on Main Street and not people like, a Soros, a Stevie Cohen, or a Ken Griffin who loan money to God. They don't care about the conventional wisdom. They care what they're thinking. If Donald Trump does well tonight in the debate, I'm thinking, oh my God, the market's going to implode on Tuesday. Really? Is he going to bring in some bohemian lady from Berkeley to be his Treasury Secretary? I doubt it. The guy's from Wall Street, for God's sakes. Do you want more does Wall Street want more continuation of regulation that we've seen under the administration? I get that the market's like calm. We don't like anything crazy, but at the end of the day, those temper tantrums go on for what? Hell, look at the Brexit. That temper tantrum went on for all of 0.25 seconds. The market has the attention span of a tsetse fly and a news anchor. We don't care if it's not really, really damn close to the boat. And busting through the 50-day moving average last week was a little, or actually we busted through it technically today. I told my folks, I said, if we hover underneath it, a couple times we've hovered underneath it in the past, or a little bit of a bust, but we made it through, or a little bit of kiss here, a little bit of kiss here. Every time there's been a bust through on nothing really major, there are only two things, in my opinion, guys, that are going to bring down this market. I mean, like bring it down. And that's oil. I forget who mentioned, this oil meeting this week. There's a snowball's chance in hell that anything happens. The only thing that's going to happen is maybe they all sit in the same room. There's not even a dude from Iran going. This is just like the Doha meeting back over in Qatar in February. Hey, we'll all agree to a production cut as long as Iran does too. Hey, wait, where's the guy from Iran? Oh, that's right. He said he's not even coming. And if you pick up your binoculars and look out the window, you can see him opening the spigots and flooding the Persian Gulf with oil. So that's stupid that oil's even catching a bounce this week. I'm short the XLE for the week on a trade, and it just makes sense. So I'm higher on the week just because I'm just counter cyclical to all of this right now. We're getting back down to holy crap Fed levels, and she said no to raising interest rates. So what are we down on? I think we're just a little nervous going into the debate and a lot of stuff. I don't see us going down any lower. I still think we're in bizarro market where a lot of this bad news will be good news for the market because as one of you guys said, hey, it's only the Fed fund futures rate's only at 52 right now, down from a 55 for December. I mean, things got to pick up and start really coming up roses for her to raise in December. I think the only time before last week that it got above 50% was in the middle of the middle of 2017 was the only time recently that the Fed fund futures rate was above a 50% chance was in the middle of next year. And now it's December. Come on now, pull this leg into place, jingle bells. So I'm going higher on the week. I don't know if it's a rip your face off rally. I think, Jim, you mentioned kind of a turnaround Tuesday and all that type of stuff. I don't know if we break the oh my God, the world's going to end if she raises rates level from last week. If we do, we got bigger problems going on. And I just don't think I see the bigger problems going on. I think it's oil and a loss of faith in central banks that will bring us to Armageddon. And that just ain't happening. So I'm getting, and I don't want to be long right now, like I was talking to Eric about, but what are you going to do? Pound this thing into the dirt? For what reason? So those are some of my reasons. I really don't think any of these economic reports or Fed lieutenants running around talking. One will say one day and the market will freak out and the other will come in and soothe it the next day. Enjoy the ride. I think we drift higher and we smoke the Fed's opium going into December. So that's my rant and I'm sticking to it. So you got any feedback on that, guys? We can have a little bit of a food fight before we move on to the next question there. But anything, yes, no's, maybes, you're smoking too much opium?
I agree completely with it's Christian. I agree completely with, what you're saying in terms of, there's a lot of negatives out there, but they haven't been bringing the market down, and there's no reason with the easy money out there until they actually pull the trigger. Then we've got something to worry about. until then, you know, I hate to use the Tina argument, but where else are you going to put your money right now? And until they actually get really serious and the Fed fund futures start hiking up where it's really going to happen, I agree. I think you got to stay the course. You just want to dodge a couple landmines out there. You know, if we're going to correct, you know, we're bound to correct a little bit, you know, like we did a couple Fridays ago. This thing is normal for the market. But until they really start to say, or until it actually happens like it did last December, then I think you got to stay the course. I think you're right on.
Anybody else? Pro, yes, no, maybe? I know, Eric, you probably agree with that, but anything else to add?
No, I mean, and just a funny thing when you were talking about with Iran not showing up to the meeting and not agreeing to production cuts, they're not going to. They're not a part of that crew. The only time that I think that they'll come out and say that they're going to limit production is maybe after they built like this secret underground tunnel to China to pipe it in there on their own. So that would be the only time I see Iran saying we're going to cut back. But
yeah, what country who sitting under sanctions for years after getting the handcuffs removed from our Manchurian candidate in chief would say, "Oh, wait, you guys want to you want us to turn these back off again?" I mean, why not? You're Shia, we're Sunni. We love each other. It's stupid. And they got their patrol boats out poking U.S. aircraft carriers and surface vessels. And it's going to be a lot of interesting stuff going on in the Persian Gulf.
And we're also seeing rig counts start to go back up again. So
correct. Go ahead.
And this is not even a live. The thing that people, you know, I think they kind of came to, they talked about a little bit more on Friday when crude went down, is this is not even a live OPEC meeting.
Right.
Oh, that's right. Good point. Yeah. So they're gonna Iran's gonna actually maybe phone in and say, "Hey, we're not gonna do anything." By the way, so that'll be even funnier. Good point. I forgot to mention that. All right, let's move on to question 4, and then I want to squeeze one more question out of you guys, which is a big one. So everybody, all the listeners, need to stick around because that one's the most important. I'm going to try and get a great, juicy trade out of these guys, either for the week or next week or out to, I don't know, January 2019, if they're so inclined. But question 4, guys, let's start from the top there. What styles of trading or methodologies have you had the most success with? Tell us how you became, you know, the 500-pound head you are, and how others can potentially as well.
I'll go first, I guess. You know, I try to kind of tailor this question to the current environment and what's been going on lately. And you know, the trade, you always have to have a trading model, right? You have to have a plan and you have to stick to it. That's number one. But I think in this market, as we're getting very little continuation, you get one day it looks great, everybody starts putting their party hat on, it's great, we're going higher, and then, you know, just like we did, I guess was it Wednesday, then, you know, Thursday and Friday, no follow through. Right. So I think you want to be extremely patient. And, you know, these are very basic things. You know, I think you want to exercise your patience, not get ahead of your skis in this market, because we're just not. So we're seeing a lot of failed breakouts. So just when things start to look rosy and you're like, okay, we're pushing ahead, we stall out. So, I think position size, you want to be very careful in this market and not take on too much size, not take on too many short-term trades if you're option trading. Without that defined risk that you're aware of. And the other thing is wait for confirmation. You know, you have to kind of sit on your hands and say, what level do I think things are going to turn? And I want to be, you know, I definitely want to participate on those turns, but I want to make sure I've got actionable signals where I'm not just jumping in just because, you know, everybody's buying on you know, at the end of the day. You know, I want to make sure things line up for me correctly and they line up in my trading plan. This way, it kind of keeps me grounded when, you know, you have one day when we're up and we're rallying and everything looks great. You know, one of my friends that I just recently talked to who develops a lot of indicators, and he's great with developing the indicators, but he's not following them. He's anticipating. And I think in this market, you want to do less of anticipating. You know, you want to have that plan if it gets there, but you don't want to jump in until you actually reach those levels and you get that exact confirmation, because I think anticipation is chopping people to death right now. So I think those are the things that are helping right now.
That's awesome. That's great advice. Okay, Eric.
Well, we were talking about probabilities of the Fed hike, and that's how I really got started, was playing the probabilities of the rate moves. And like I was talking, we've all been talking about, I should say, of the next Fed meeting has a probability of a rate hike, but we look out in time throughout next year, and that probabilities are of them lowering interest rates. So that's how I would play it. In a sense, I would be buying those long dated Fed fund futures and selling these close dated ones, because the probability of them raising right now, going into a holiday season, and lowering interest rates next year are not there. That just doesn't happen. I mean, I guess you could say that they really don't know what they're talking about or what they're doing, and they were going to raise it at the inappropriate time and then have to lower real quick. But the probabilities just aren't there, especially with a rate cut. So that's what I moved on into doing options trading, as I started saying, well, God, with options trading, I can play the probabilities and in a very similar way. So that's what I do with options. Like you mentioned earlier, you play the strangles or whatever. That's what I do. I sell premium when I can. Right now with implied volatility so low, it makes it difficult, but I play around with options probabilities for success. And that's how I found to generate most consistent winners throughout time. I do look at technical analysis in the sense that I look for things to start to trade in a range bound area and breaking out of those and Fibonacci levels and things of that nature to put on those levels to just give me a little bit of a confirmation to my theory on the probabilities. So I think I can increase them a little bit if I can get above maybe say a Fibonacci level. That's might be where I increase my size a little bit more on a particular trade. But for the most part, I am playing probabilities on options.
Great. Good advice, Eric. Oh, I'm sorry. And then Roy. And to transition to Roy.
Yeah, so when I started out with Steady Trader 2 years ago, I took some time to do some research on the market, and I developed my approach because I came to the opinion that the market has seen a fundamental change in its structure and its architecture. Some of it's due to computer-based trading, which is now, of course, that's just the way it is. And that, all the big buys, the big institutional players, they basically have the same algorithms. So we're seeing a lot of, just a lot of control over the market. I mean, it's so range bound. And we came to the conclusion that in this environment, the safest way to trade, and we're big on safety, is trade the middle of a trend. I mean, forget about this ego, forget about trading for trophies. We use our technicals to identify a trend. We get in only after it proves itself the next day. We make sure it goes up a little higher, and then we get out before we lose any money on it. I mean, it's all about just cutting into the middle of the trend and getting out every day and making a few pennies every day and just adding them up day by day, month by month. And it's been working for a couple of years. There's nothing really, no rocket science to it. It's just very, very conservative, down the middle trading.
That's great, man. Hey, a billion here and a billion there. Soon we're talking about real money. So it's
well,
slow and steady wins the race.
So much like everything else in this country, everything is drama, right? And everybody wants to have the big win, the 30% gain and this and that. And you know what? They're there, but the little gains are there every day. There's always
Correct.
Little gains every day. I'm not saying we have executions every day because they have to prove themselves, but we're out there, we're swinging for a base hit every day, but we're not swinging for the fences. And as you probably know, Babe Ruth in his day was the home run king. He was also the strikeout king. So
correct. That's exactly right.
And we do not like losing money.
That's a great way to put it. It's and it would be shocking to many of the folks on this webinar listening that, as at least during my time in Chicago, the average pretty decent trader looked to win I don't know, about 60 to 65% of the time. And when I tell new people to TGO that, they fall out of their chair. And I'm like, well, that's why you're a retail trader. If you're sitting there wanting to win on every trade, you'll probably be done in 0.32 seconds. And I raised mine up to about a 0.7. That's kind of the win rate I want. But people are shocked. But when you do the math for them and say, hey, if you're winning on 60 to 65% of your trades over time, you're crushing it. You'll retire in a couple years, and they just don't understand the math. So I can certainly appreciate what you're talking about, Roy, because it makes total sense, obviously, to most of us, all of us on this panel here, but not to a lot of retail folks, and that's where they strike out. So that's great advice, very good advice. And finally, Jim.
Sure. One thing right off the bat that I like to keep an eye on is the flow of money, and that's where the moving averages kind of have meaning to me, because they're based on the price and time, and obviously they give you some idea of the flow of what's been happening. The other thing is you want to look at what you know and what you don't know. And what you know is what's currently going on, right? And what you don't know is obviously what the future holds. So right now, we're clearly in a range-bound world. The dollar index is trading between 93 and 98. The S&P is between 2,200, 2,100. Gold's between 1,400, 1,200. Silver looks a little undervalued to gold because the ratio is 70 to 1. And when it topped out at their high prices, it was 40 to 1. And when they bottomed earlier this year, it was 78 to 1. So, and silver's been a better performer percentage-wise, but it's in a range right now. Interest rates, the 10-year notes yielding 175 to 155, and the oil's between 50 and 40. Now, you want to throw on top of that, you probably have the largest complacency that we've seen. Earlier this month, I was on a broadcast and I told everybody that August volatility for the S&P stock market was the lowest level since 1965. I don't know if that hits everybody as it hits me, but it hits me that obviously when I was on the broadcast earlier this month and the VIX was 11, and I say the volatility is at a 1965 low, obviously strangles look pretty interesting because obviously you're paying pennies and you have limited risk. Obviously, some of those options after that broadcast we had after Labor Day went from $200 to $2,000, which was obviously evidence that the volatility jumped 46% right after the broadcast. The point being is that I like to also get a little bit of a bigger picture here. We've had obviously a very large run, but the reason people aren't making money shorting the market is the flow of money is not going down yet. But if you're looking at some of the stars, like your Starbucks and your McDonald's and your Johnson & Johnson's and your Home Depots, those stocks on a 10-year chart have had a very large run, and they do seem like they're losing a bit of altitude. So again, what have the companies been doing? They've been issuing bonds, and rather than taking the debt that they brought and getting plants and equipments, which I think Matt brought up that they're not doing, they're buying their own stock back. And companies like Macy's did that, and the stock's gone from 52 to 36. And I would imagine Macy's isn't very happy about buying all that stock back. And so look at the chart on the S&P and the NASDAQ, and just imagine borrowing money and buying the hell out of stocks up here. Is there a risk to that? And again, right now it's not a risk, so that's why the complacency is at a 1965 low. But talk about whistling in the dark. If we're not whistling at the dark here, then, obviously my compass is way wrong. But you do not sell things that keep making new highs all the time, because that's a very good way of getting run over. But when and if you do start seeing deterioration under 2100, under 2050, under 1980, I don't think this time it rolls over is going to be a joke. And so I like to just say that with all these rain-bound markets, maybe the smartest thing to do is let them break out and then obviously go with the flow. And that might be something to try to do here, because this complacency, I think, is shocking. And we're not being complacent at the bottom. Everyone's walking around with that Tina lady. That Tina lady, there is no alternatives. That lady's going to bite somebody at some point. She could be very much the kiss of the Spider Woman by the end of the first quarter, because the end of the calendar year and the beginning of the new year, Believe me, I have 100% confidence that we're not going to stay in this doldrum through the end of the calendar year and the beginning of the new year. People are going to start moving their money once they start seeing the cards come out of the deck. Me being in Las Vegas, I'm sorry about that analogy, but they're going to start seeing how the river runs, right? And they're going to start seeing is the Trump guy going to do it? Or either guy who gets elected, they're all talking about spending a whole bunch of money, and that's going to take the budget deficit really high, and that's generally not good for your currency. And that means these commodities may have a future in them, and they certainly, on their 10-year moving averages, have started to turn up, and that's not an easy moving average to turn up. So there's going to be a lot of excitement here. And again, all these range-bound markets that are dead in the water, by the end of the calendar year, beginning of the new year, I believe somebody's going to be throwing rocks in that lake, and there's going to be some ripples. And that's my 2 cents today.
Well done, Jim. That's you nailed a lot of points there, and I hope everybody really paid attention to that. I mean, hell, man, when the current occupant in chief has been incredibly lucky that we haven't raised interest rates. Can anybody do the math? Actually, I used to know what it was. Now it's
well.
Even
One
higher.
last thing, Matt. I just want to interject one thing. Have you ever seen a president take office in 2008 and been able to sit back and let the Federal Reserve and the Treasury just print money to have such a steady uptrend through the entire presidency, never have much of a hiccup along the way? I mean, talk about automatic pilot. This guy had one of the great presidencies of all time as far as trouble, problems, and everything else.
Well, that's what's funny. I mean, but also he's the only president, I think, in our nation's history, or since somebody in the 30s, and I was a political science major, so I forget, who's never had a GDP of greater than 3%. So we've just kind of muddled around in this economic Vietnam for the past 8 years, and everybody thinks it's been absolutely fabulous as long as you're inside the Beltway. But the second she raises interest rates, 25 bips, I think, is like $100,000 billion of interest. I mean, we're not even going to be able to afford the interest payments on our debt when interest rates go up. So that's one of the scariest math problems that I've seen. I'm like, holy crap, I completely forgot about that. Since we've had this near zero interest rate policy, we're not paying, he hasn't been paying interest on anything. So, but in answer to the finer question, folks, there's software out there, there's people out there, there's all sorts of things out there to quote, make you a better trader. I got to be honest with you, man, unless you're one of my Marine buddies, the 7 inches of gray matter between your head is one of the most valuable trading platforms. Arming yourself with knowledge. I mean, most brokers, I trade with Options House. Side note, I helped build it when I was at Peak 6, so I'm a little partial. But any brokerage platform has tools that rival, or if not exceed, some of the professional tools I saw on the floor at Peak 6. Why? Because brokers want you to trade with them, and they want you to spend money or trade so they can make commissions. So there's a lot of tools you already have at your disposal to make you a pretty good trader. You just need to learn how to use them. After that, my motto here at TGO is trading is a form of combat. When you think about it, somebody's going to win and somebody's going to lose. And I'm pretty sure everybody on this webinar today wants to be on the right side of that trade. Ain't nobody like losing. Ain't got no time for that. So I really teach my folks how to do some strategic and operational thinking all the way at the high level. There's been days where retail traders wake up and it's like, oh my God, why are the futures down and my portfolio is getting hammered? It's like, well, you didn't know that Putin was about to invade Crimea and eastern Ukraine. Oh, I did. I have a lot of buddies in Pentagon. That's one of the benefits at TGO is one of my buddies just made 2-star admiral. So I get a lot of maybe not so. I know a lot of what's going on, but seriously, look at the Greek crisis. Hey, they're going to kick them out of the euro. I'm like, no, they're not. Selling to that pop, or they're going to stay. I'm like, well, they're not going to agree to everything. We rode that thing for about a month, that heart rate monitor. So you really got to use your brain in trading, and it's not necessarily standing on the floor and trying to price a straddle, staring up at the ceiling. That's not what I'm talking about. I'm just like using your brain in trading. Like I talk about how folks are going to react, or the market's going to react to this election. We placed 2 VXX trades in the past couple weeks. And I think, Jim, you were talking about vol is going to go up going into a Fed meeting if they're going to raise interest rates. Well, there's only a 14% chance, Whiz. You don't run a $20 billion hedge fund and go, I'm pretty sure she's not going to raise rates. And then she does. You're going to be running down the street getting chased by pitchforks and torches. So you have to hedge. So we had 2 layup trades over the past 2 weeks. We put on a bullish double vertical going into the Fed meeting, and you guys saw what the heart rate monitor looked like going into that. And we got out with a $8,000-9,000 profit. And then it's easy. I hate saying this. It's like shooting fish in a barrel, but guess what? If you knew there was only a 14% chance and you didn't think she was going to raise rates for a whole host of reasons, do a bearish double vertical. I call it rolling inverted. Let's pull up and do a bullish double vertical, roll over. We did a bearish and we made about 12 grand in 2 weeks just on 2 trades. And we'll do the same thing going into December. So my advice to everybody here is you wouldn't be sitting here. You wouldn't have accepted David's invitation to attend and listening to Christian, Eric, Roy, Jim, and I, without having some sort of a brain stem at a minimum and a brain on top of it. So use your brain. There's enough smart folks out there like the guys on the panel today that you can talk to and have mentor or sign up for some of their products. But at the end of the day, it's ultimately you're the pilot in command. You got to fly and fight your airplane. If you're waiting for somebody to reach their hand in and grab the stick and fly your own plane for you, you're both going to get killed. Okay, so I'll leave it at that. We got 4 minutes left, and it's going to be a lightning round. So we're going top to bottom real quick. You got like 15, 20 seconds. What's your either trade for the week, a short-term trade, or long-term trade? What are you liking right now? And it's a lightning round. Go, Christian.
Okay, well, quickly, and I really liked I really liked what you had to say about the market and the expectations going into the Fed and trading the VXX, which I think was an excellent trade and awesome profits on that. But just like you were saying, you got to trade like what's in front of you. And I'm looking at the JCJ index. So while I was negative in the beginning of the call, what's positive right now? What's positive is that the correlations between single stocks, unless volatility really starts to pick up, it's still a stock picker's market. We're down here, which means correlations are not together. So let me fast forward because you said really go quickly through this. So what am I looking at? What stocks are moving? Which stocks are trading up? And I really liked what Jim had to say about consumer discretionary. You look at flows year to date. Consumer discretionary in ETFs has lost $5.4 billion. If you fast forward to the last 3 months, so that's year to date. This is 3 months. Nothing's changed with consumer discretionary. They're still pulling money from consumer discretionary. Nobody wants to be there. Where do people want to be? They want to be in materials right now. Gold miners, even though they've dipped the last couple of weeks. So I'm going to get into trade number 1, which I like gold right now. I think gold has been. So sorry, I've got. I know I'm going over your time limit, but if you go through, GC or GLD, and you look at a weekly chart or you look at a daily chart, it's basically been consolidating. Which I can't get Thinkorswim to work for me, but it's for the last month or so, it's kind of been consolidating. I think it resolves itself higher. I think with the election, everything that's going on, I think setting up a long in gold makes sense. You could also do this through the GDX, but that's where the money is going. People are still adding. If you look year to date, it's $7 billion, but the last 3 months, people are pouring in money into the gold miners here in the last 3 months while it's been going sideways here. So second trade that I have, which I will go through really quickly, sorry about that, is transports. Transports are something, the Baltic Dry, this is not bearish. The Baltic Dry is up 33%. Nobody's talking about this in the last month. That is a good proxy for global commerce. If that is going up, names like FedEx just had good earnings, UPS, you could look at this inverted head and shoulders. If it breaks, so just as I was saying before, you have to wait. You have to wait until it gets above this line. But I think above 145.75, you can go long IYT. That's the transports ETF. And then finally, again, I apologize, but I like biotech. I'm just waiting for it to come in a little bit further. I like small cap biotech. There's a lot of good things. All of the bad things, I know it's election time and it's going to be in the talk, but I think a lot of it's come off. And I think it's fairly valued right now. And as long as it's above this line, which is the yearly value area, which is 6407, I think you can remain long XBI. So thank you very much.
You bet, man. That was certainly a lightning round. Eric, over to you.
All right. So can you guys see my screen
Yes.
share? Okay. So mine's in GDXJ, which is the junior gold miners for gold. I don't really see it moving a whole lot higher than what we saw at 52.5. So I'm looking at doing the October 40.52 strangle, and I collected $1.05 for that just before we pretty much went on. And then I was going to ARB for you there, Whiz, but and then onto the can you see my General Mills here, ticker symbol GIS? General Mills, basically, we've had a 10% pullback here. So I did it as a synthetic long and did the October long 65 calls, short 65 puts, and collected $1.47, which puts my break even right below where it is currently trading. So those are the two trades that I've put on today. I'm looking for General Mills move higher. They beat earnings. Plus, I think if we start seeing some bad economic data, people are going to throw their money into some of these staple products. So
yeah, I like that. I'm in the XLP, so I agree with your thesis there. That looks good. Roy.
2 words: lumber liquidators.
That was the shortest one, man. That's awesome. I love it.
Well,
liquidators.
We're out of time, but it had a good run up the end of last week. It's stable today. If it starts to move up again, I think that's going to go for another probably 5 to 10% in the short term.
Sounds good. I like that. Jim.
Well, a couple of things. One is the metals that was already talked about. The gold and the silver, as far as the long-term moving averages, have definitely turned up. The reason the silver looks a bit more interesting is the gold to silver ratio. When they peaked out at 1,900 gold and 50 silver, it was 40 to 1. Silver dropped about 75%, gold about 40%. So that's indication how silver was overvalued then. And since we bottomed at about 14 silver and 1,100 gold, gold's gone up about 25%, best case on the rally. Silver went up to 21, that's 50%. So that's giving you an idea that it's outpacing gold now. And it's at around 70 to 1. So that's interesting to me looking longer term. And on the stock market, with all the stuff that I, put together, it's hard to be really confident buying the all-time highs with both hands here, but that might be the way to go. Marty Zweig, the late great Marty Zweig, used to say, "Don't fight the Fed and don't fight the tape." So that's probably something that we have to keep an eye on as we go on. There's 3 stocks, MasterCard, Visa, and Amazon just really went through the roof. So that's either telling us the consumer is really healthy, or it might be a blow-off near the end of a cycle. I think we'll know what the answer to that is in Q4 and Q1. But all those risk factors that I talked about are no joke. And so if we did get deterioration of 10% on this market, it could lead to a much more significant drop. And I wouldn't discount that as crazy talk because, again, we'll have to see how things unfold. But that silver gold situation, they do seem like they've made a turn this year. Only time will tell if there's going to be an acceleration phase in the months ahead.
Awesome, Jim. Thanks. And finally, me, just real quick, folks. Here's the VXX. We can get into a 19.7 hour debate on VIX versus VXX and trading it because a lot of people retail just don't understand the difference between the two. But I'll leave that alone. When volatility is cheap, you buy it. When it's expensive, you sell it. You write that down, you'll have a great rest of your career as an options trader. Vol's a little high today. We got a nice little pop on the VXX today of 5% with this little bit of it's kind of a Seinfeld implosion. It's on nothing, in my opinion. Nothing too crazy. But if we could slide this forward in time as we go through October into November, the beginning of November and the election, volatility is going to increase. And we've all kind of disagreed on who would be better for the market or whose Wall Street runs or whatever. Doesn't matter. Whenever you say the words uncertainty, there's a lot of uncertainty around this market. I love the tight polls between the two candidates because that means me buying some vol. I love it. Please stay in a tight race. It was 15, 2 months ago, it was like, Trump's down by 15 points. You might as well, why not just quit now and we'll make her the queen? Unless you were a complete idiot, you knew that the polls, no matter who she was running against were going to tighten. They're going to be super tight going into the election. Uncertainty is going to increase. Volatility is going to increase. And then I'm going to put that on. And as VXX pops going into the vote, just before the vote, you can't. The VXX and trading vol is like my dad at the airport, bless his soul. He'd be like, "Hey, Matthew, can you take me to the airport tomorrow at 8?" I'm like, "Dad, your flight's at 1:30. He's like, I'm like, "Did you get an earlier flight?" He's like, "No, I'll sit there with my book and I'm happy. But, you know, if I'm late, 1 minute late, they're not bringing that jet back for me," which they should have because he was the greatest guy in the world. But he was right. So if you wait until Hillary Clinton declared the winner and you try and get out of that trade, you're going to be broke. So you get out of these VXX trades early and put the opposite one on early as well. I'll be bearish on vol on like November, whatever it is, 4th, 5th, or whatever. Well, Wiz, we don't know who the winner is. I don't care. I'm going to take my chips off the table, and then I'm going to put some other chips on and then go home and make a pot of money, hopefully, potentially, on what's going on with the election. So that is what I plan on doing. That's going to be my trade of the week, talking to my traders tomorrow when I do a primary live trade brief at 9 a.m. So, Dave, I'm going to throw it back to you. Sorry you didn't get a chance to do a roundup with the guys here. I ended up going a little long there, and sorry about my comm issues. But I know in the recap you let people know how they can get in touch with all of us who were on the panel today, who took some time out to do this. So I'll throw it back to you, David.
Do you guys want to take a couple extra minutes and do a quick?
No, I'll just talk about me, and the other guys can shut up. So that'll be fun. So. My folks, it's real easy. My name's Matthew Buckley. Wiz, you can go to topgunoptions.com is where you can track us down. And if you go there, or actually if you go to topgunoptions.com/FT-now, it stands for full throttle -now. You could grab one of our monthly slots where we do live trading and training throughout the week. So not going to talk too much longer since I was the one that made this long. So Christian, over to you.
Thanks. Yeah, just similarly, you could go to our website, TribecaTradeGroup.com. We put out a newsletter every weekend with our thoughts and trade ideas, a couple of them that I already mentioned. But you could download that for free. You could just go to our blogs and video sites. You can kind of get a little bit of a taste, a little bit of a flavor for the kind of content that we're doing and the analysis that we're doing. And then if you're interested in signing up, you can go to the products page and you can check out our trading room for a month. So check us out, TribecaTradeGroup.com. Thanks very much, and always enjoy being a part of the panel. Thank you, everybody.
Okay, who is next?
I usually go after Christian. Eric Wilkinson, you can find me at Pro Trader Strategies. I agree with Wiz in regards that you sell volatility when it's expensive, buy it when it's cheap. That's why I did the GDXJ trade volatilities at the higher end, up above 50 IV% in there. That's why I sold that strategy. But I go through all of that stuff. I do webinars on Friday, like I mentioned, daily market commentaries where I talk about all of the trades that I'm putting on, why I put them on, and when I take them off, and how I defend those. So you can find that. I have a lot of different courses on my rules around something like GDXJ, why I sold that strategy, and or tactic, and all of those rules around different option strategies that I use.
Awesome. Okay, Roy.
Yeah, you can find out about my system at steadytrader.com. Not the Steady Trader, that's some other guy who stole my nickname, but steadytrader.com. We've got a free book, an ebook, Read This First Before You Buy Stocks. That covers all the research I talked about that we did prior to developing our strategy. We've got the trials you can take. We have Scan Room. So go to the steadytrader.com, poke around, see if you like it.
Thank you, sir. And finally, Jim.
Sure. Optionprofessor.com. They have the 7 DVDs, which go over the uses and the risks of option trading. You know, option trading is not right for everybody, but to find out if it might be right for you or suitable for you, you need to learn the strategies and what the risk is on all the different strategies, and then proceed with caution. But knowing the different tactics and how you could use them and what kind of opportunity and risk they present is really imperative, and that's what the Option Professor DVDs have been doing for a very long time. So go to optionprofessor.com and check them out.
Awesome. Thanks, Jim. I appreciate it. David, back to you, my friend. Thanks for having me, and hope to see you and work with you guys again all soon.
Yes, thanks for having us.
All right. Thanks, guys. Great show. Just want to remind everyone who's watching, you can go to TimingResearch.com and download any of the past reports there, or watch any of the shows, including this one in a few minutes. The archive will be available. Also, be sure to subscribe to our YouTube channel so you can get notifications about future shows and anything else we might post on YouTube. Join us next week. We're going to have Lance Ippolito, Jason Jankowski, John Thomas, and Rob Hanna will be moderator. And so just want to thank all my guests again for this week. Christian Fromhertz of Tribeca Trade Group, Eric Wilkinson of ProTraderStrategies.com, Roy Swanson of SteadyTrader.com, Jim Kenney of OptionProfessor.com, and of course Matthew Buckley of TopGunOptions.com. Thanks for moderating again. So anyway, thanks guys.